Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with John Rubino. We'll talk some of the seasonality for gold and markets, as well as some other commodity news that has caught John's eye. If you want to follow along with what he's writing about economically, market-wise, even individual stock-wise, you have to follow John on Substack, which we will post a link to his Substack in the show notes. John, seasonality. We are in September. Summer is finally behind us, and just last week we saw a big uptick in volume, and we also saw some pretty big red candles in almost every sector out there. But we've heard from a lot of generalists that, look, seasonality-wise, September is a weak month for markets, and even off mic, you were saying how seasonality usually hits gold this month in a negative fashion. What's your takeaway then, John, about really gold's hanging in there? It's not very weak at all. Everything else seems to be weak around it, but how do you play this seasonality?
Hey, Corey. Hey, Shad. Good to talk to you guys again. Like you said, September is usually a bad month for gold, but the summer's not usually that great anyhow, and gold has done just fine during the summer doldrums. So it could be that you've got central bank buying on the other side of the equation and some money starting to flow back into the ETFs that are offsetting the seasonal weakness. And so who knows? In any event, one month does not make an investment strategy. So you really shouldn't be doing much more than putting the occasional lowball bid in for a miner or something like that during the weak part of the gold cycle, because too many other good things are happening in the global economy for you to be betting against gold in any meaningful way, possibly offsetting what's happening with gold weakness right now to the extent that there is any. But Russia is the big central bank story lately. They're generating a lot of oil revenue, which means that the U.S. sanctions didn't work at all, really. And so Russia has cash, and they're converting that cash now into gold. And it could be that right there is enough to offset any weakness in any other part of the gold sector. So yeah, we really can't know. The important thing is that the longer term story for precious metals is phenomenal because, we are just blowing it on a biblical scale financially around the world. The people in charge right now, who've been in charge for a long time in most of the West, inherited reasonably healthy financial systems, and they've just ruined them. So I don't think there's any choice but to try to inflate our way out of the mountain of debt that's coming in. And that's arguably, other things being equal, going to be really, really good for precious metals. So yeah, short-term weakness possible, long-term strength almost guaranteed going forward. And from our point of view, right, guys, the question is, when does that filter into the miners and start making their stocks go up dramatically? And that's unknowable since it should have happened already and it hasn't happened yet. But I think that's somewhere out there. The strong market for precious metals, physical, starts to put a wind at the back of the miners and we get a really good cycle, but I just don't know when that's going to be.
Well, John, when you look at some of the macroeconomic drivers that are out there, it's creating uncertainty in the equity markets. So not just in resource stocks, not just in gold and silver stocks, but in the general equities and in other stock markets as well on a global basis. So when you look at this rate cutting cycle that central banks are going under, and the Fed is about to start theirs later this month, when you look at the geopolitical uncertainty in many areas of the world, but also the political elections in the US, when you look at people not really sure what the future is going to look like as far as trade deals, as far as tariffs, as far as the influence of the BRIC nations, there's so many cross currents. Do you think that's causing some people to disfavor gold and not the gold equities because, hey, at least it's a store of value in uncertain times?
Yeah, I think the geopolitical thing is a big deal for the miners, in part specifically because of what's happening in mining, not just the political chaos that's going on around the world, but a lot of countries are changing their regulations as regards mining in unfavorable ways. Mexico's the latest. They were talking about banning open pit silver mines, and now apparently they're talking about maybe nationalizing their silver resources, things like that. That makes mining stocks a lot more risky than there used to be. There was always geopolitical risk, but usually it was site specific. One country was just doing stupid things and most of the rest of the world was okay. And now you just don't know where You don't know who's going to do a really stupid thing regarding their mining industry next. And that's just adding a layer of risk that didn't used to be there, which means mining stocks are less valuable, other things being equal, than they would be if geopolitics was a lot more settled. And I don't see that changing anytime soon. But I do think that the successful miners who aren't being messed with by the governments running their jurisdictions are going to put up some really good numbers with gold and to an extent silver at their current levels, and that's going to be very helpful. And it's going to lead to a lot of M&A because free cash flow, you got to do something with it. You can raise dividends, you can buy back some stock, but then at some point you got to start buying other companies. That's just how human nature works, especially in the mining industry. So there's a lot of favorable trends for the miners, and they just have to overcome the unfavorable ones that are kind of dominating right now, I think. And by and large, generally, I think that'll happen, in part because it's not in a country's interest to completely antagonize its extractive industries because they provide a lot of jobs, they provide a lot of tax revenue. It's easy to talk a good game about what you want to do with mining, but it's very hard to create a new policy that generates the same amount of cash and the same number of jobs that it did previously. So I think a lot of countries won't go through with a lot of the things they might now be considering, and that'll help too.
So, John, when it comes to the relationship between gold and the gold stocks, look, gold is doing well. However, we do look back to some of the other historical references we have to when gold took off and the gold stocks just went to the moon. We have had a few bulls come on the show and say, this environment that we're seeing right now looks like the 70s or the kind of late 2000s, that 2008 through 2011 run. But we look at the gold price during the 70s and that 2008 to 2011, the gold price went up like 6, 7, 8 times. And then the gold stocks kept moving, as well as gold is done right now on a dollar basis. You go back about 8 years, gold is up a little bit more than 2 times. So it's still a long ways off that 6, 7, 8 time move. Is that the problem then, or are we just needing gold to go through just more of an exponential rise to pull these gold stocks higher?
Well, I think there's a price at which the miners just have to be bought, right? And we don't know what that gold price is going to be going forward, but
we've heard it would be 2,200, 2,400,
yep.
2,500. What is that price going to be?
Yeah, exactly. What is that price? Because I would have said 2,000 would ignite a bull market in the equities. And then, all the geopolitical stuff happened and earnings just didn't turn out to be nearly as good as they should have been with gold at 2,000. But that doesn't mean there's not another price out there that actually does work. And over time, given how messed up the global financial system is and how all the central banks of the world really have no choice but to reliquefy their systems and try to keep the bad debt from going bust in a cascading way and sending us back to the 1930s. The central banks have to lean against that. And the only way they can do that is with extremely easy money. And historically, that's been great for precious metals. So it's reasonable to think that gold, even though it's $2,500 an ounce, is a price. I think if you asked me 5 years ago, I would have said, okay, I retire when it hits $2,500 an ounce. But even at $2,500 an ounce, there's still room to run because the amount of debt that's being taken on, basically by the whole West and a big part of developed Asia, is parabolic now. Those lines are going straight up, which means that a reasonable gold price for a financial system the way it was 5 years ago is no longer reasonable. Now it needs to be a lot higher to offset all the new currency that has to be created to manage all the new debt that's being created. And so, I don't know what the upper limit is for gold once this really gets going, because you see a lot of estimates of, what would it take to back the American dollar with 40% gold, say, and that you get like $10,000 an ounce when you run numbers that way. And with the whole world basically making the same mistakes that the US is, it's hard to know what the upper limit for something like gold is when the chaos really takes hold. So I think the prognosis for gold is positive. I think its price goes up over time as more money is created and thrown into the system. And it's just a question, is $3,000 an ounce enough to light a fire under the miners? And, the well-run miners generate immense cash flow, even at $2,500 an ounce. The second quarter earnings for Barrick and Newmont and Agnico Eagle were all good. They all had positive cash flow year over year, or positive cash flow growth year over year. And they'll probably have, similar numbers in the third quarter. So we've got 2 quarters of good looking cash flow from a lot of the big miners out there, which in and of itself is pretty exciting. And it gives those big miners a lot of extra ammo to go out and build some empires and buy up some of the high quality producers and maybe some of the explorers. So this is all kind of part of a big trend in which we screw up our financial systems. We have to inflate our way out of it, and gold and silver go up. Those trends are all in place, and they should lead to better prices for precious metals. So I think it's reasonable to be positioned in front of those trends. In other words, set yourself up so you benefit from these things that almost have to happen. Barring World War III, aggressive inflation on the part of central banks is pretty much baked into the cake. So, I'm not worried long term about gold at all, and only modestly worried about the miners, because I think having the price of what you sell keep on going up papers over an awful lot of mistakes and problems. And that's probably going to be the case for the miners going forward.
Well, John, I'd like to get your thoughts on the royalty sector, because I follow your Substack writings and I enjoy reading it. And you often will highlight the royalty sector. Not only do they have fat margins, but they don't have concentrated jurisdiction risk because they're usually spread out over many countries. They don't have concentrated operator risk because they obviously have partners all over the place with different companies running their mines, producing their mines, or developing and de-risking future mines. Do you think the royalty space is maybe a good defensive area to hang out where you get the upside of margins, but maybe without the single company risk?
Yeah, that's a much better business model than actually mining. But we found out in the last year that it's not a perfect business model, because it's still possible to get over concentrated in one mine or one country. And it's still possible to have your investments, in other words, your royalty and streaming deals, be impacted by geopolitics. Franco-Nevada was that was the gold standard, the best company in this space. And it turns out that they'd put 19% of their capital into the Cobre Panama mine, which looked like a sure thing, but it turned out it wasn't. And so that's Franco-Nevada is now, it's in my portfolio on the Substack, and it's down from where I recommended it by 15 or 20%. And, that was the best company in the space. So it's a really good business model, the royalty streaming model. And I think on balance, those companies are going to do very well going forward. And there's going to be a lot of M&A there. There's a lot of little royalty companies that can be bought out. We'll just see what the premiums are going forward, but there will be a lot of them bought out, I think. And you mentioned margins, and that's one of the really exciting things about royalty streaming companies is that they contract for gold or silver or copper or whatever at really low prices by putting some money in up front. And for instance, Sandstorm, their margin is like $2,000 per ounce of gold equivalent. So you make $2,000 on every ounce of gold you sell, and you can't help but be profitable, right? So their issue is that they took on a lot of debt to get a lot of those royalty streaming deals. So they've got interest costs and the risk that comes with being over indebted that they have to deal with, but they're dealing with it because they're generating enough cash flow to let them take a decent sized chunk out of their debt each quarter. So yeah, I like the royalty streaming companies, but I'm kind of leaning even further towards the physical ETFs now, though, because that basically, not only do the physical ETFs avoid geopolitical risk, they actually benefit from it. Because say you've got a a big warehouse full of uranium, or wherever they keep their uranium in the Sprott Physical Fund. I'm thinking of it as a warehouse, but I honestly don't know. But you've got that uranium there, and then some country that's a uranium producer has a coup or something like that, and their uranium mines go offline. That's bad for the miners that had interests in those mines, but other things being equal, it makes uranium's price go up, which is good for the physical ETF. So that category might be the bedrock part of a precious metals portfolio now, instead of the royalty streaming companies. Although I still do like the royalty companies, but personally, I'm adding to physical ETFs. And then Sprott just brought out a copper physical ETF that doesn't trade in the US. At least it doesn't trade on my Charles Schwab account where I would normally buy it. But when that's available, that would be an interesting thing to buy, because copper is something that doesn't have any physical ETFs. And when it does, it's definitely a must add to a portfolio of physical ETFs. So yeah, I think we should pay attention to that sector. And one other thing about physical ETFs is that they trade above and below their net asset value sometimes. So you can buy the Sprott Physical Uranium Trust sometimes for less than its net asset value, which gives you an incremental improvement in your return by doing something like that. So anyhow, an interesting idea to add to the others.
We have seen some of those physical ETFs trade below some of their asset values. It's been interesting to see, but that also just shows when the market is very much unloved. And hey, John, you're not alone moving into the ETFs. It seems like a lot of investors are still focused on the ETFs rather than taking that individual company risk. And royalty businesses, yes, it is the superior business model. They just need to keep on making deals and letting some of their assets develop, which can take a while, but at least these companies aren't on the hook for massive builds and massive cash calls, but they do carry debt. John, always interesting chatting with you. We will chat again in about 1 month's time. Again, if you want to follow along with John, click on that link in the show notes to visit his Substack. John, thanks again for your time today.
Thanks, guys. See ya.